Welcome to the State of Fintech podcast. I'm Destiny Day, Vice President at York Public Relations. My guest on this episode is Dr. Angela Murphy, Vice President of Marketing and Solutions at Pidgin. Today, we're diving into instant payments. The 2025 State of Fintech Report shows that real-time payment rails like FedNow and RTP have moved beyond the experimental phase. Instant payments are becoming table stakes, but implementation brings challenges most institutions simply underestimate. Legacy systems weren't built for transactions settling in seconds. Fraud prevention strategies need complete overhauls. And liquidity management needs get more and more complex. Community FIs face a decision: invest now or fall behind. Angela's here to share what true readiness looks like and where institutions should focus their efforts. Let's jump right in. Welcome, Angela, to the State of Fintech podcast. It's wonderful to have you on. Would you like to introduce yourself and talk a little bit about Pidgin?
Absolutely. Thank you so much for having me. I'm Dr. Angela Murphy. I am the Vice President of Marketing and Solutions at a company called Pidgin. We are a payments fintech based out of Atlanta, Georgia, and we focus on providing connectivity to the instant payments rails for banks, credit unions, corporate credit unions, and bankers' banks. So we are essentially the connectivity and translation layer for all things instant payments.
I'm going to start off by just making a statement, and we can maybe have a discussion about it. But the 2025 State of Fintech Report highlighted the instant payments adoption as a critical trend. Is there anything that surprises you the most about where the industry stands today?
I think the amount of institutions and leadership in financial services that is still in the wait and see format for instant payments, we are no longer there. I've been speaking all year about the fact that we're now in the fast follower phase, is what I'm calling it, because early adoption has long been over. The early adoption phase actually ended about this time last year. So for institutions that approach me and say, oh, it's a wait and see, I'm like, oh, so you're planning to fail.
And I mean, this may be getting into a part of the discussion later on, but what is causing that wait and see mentality?
I think that there is always a little bit of inherent tension in financial services between traditional institutions and core providers and the concept of fintech or fintech companies being involved in this space. That tension has been here for well over 10, if not 15 plus years. And there's this reticence to change that I see for a lot of people where they're in the camp of, it's always been done this way. Mm-hmm. Well, us always been doing things this way is what led to the rise of companies like Block, PayPal, Cash App, and Venmo.
All things I've used in like the last month.
And many people have. When you get to a certain generational point, in the US in particular, people are looking for instant experiences. I call it the Amazonification of individual expectations. And that then carries into their business relationships, into their roles in their companies, and into how they perceive money movement and their financial institutions.
There's a lot of talk with FIs about this concept of getting ready for instant payments. What does true readiness actually look like?
So I have kind of two different answers to this question that are at a different level of pithy. So we'll see which one resonates with the audience. The first one is, if you stay ready, you don't have to get ready. And the second one is, if you're waiting to be ready, you will never be ready. And it's something that I used to tell my students, because for those of you who don't know much about my background, I came out of academia. And I noticed even in my students at the time, but also I see with, fully career adults, that they say to me, oh, well, when we're ready, we'll get there. Mm-hmm. That doesn't happen. At any point when some kind of innovation, technology it emerges, and it's not necessarily because people were ready, it's because stuff needed to happen. And that's really where we are with instant payments right now in the US. Now, from a more strategic point of view, and if you take kind of the pithiness out of it, at Pidgin, and then also me personally, when I consult with financial institutions, I ask them what their payments data is. How many ACH transactions and volume are you processing? How many wires and volume are you processing? How many checks and volume are you processing? And a lot of times I don't get a straight answer to that question because payments is being treated like a silo when it's actually a horizontal approach across your institution that will allow you to not only maintain your market share, but to compete for additional market share.
Okay, so what's the biggest misconception about instant payments that you're encountering when you talk to banking executives? Is it that getting ready myth?
Part of it is, and there's also this really funny thing that practitioners do when I'm speaking to them in person or when I'm doing a webinar or anything even similar. Somebody will walk up to me at a conference and say, and this is, it's getting less and less now, but it used to be super common about a year and a half ago. People would come up to me or raise their hand and say, well, Angela, nobody's walking into my institution and asking for an RTP or a FedNow. And I would have to sit there and think about that perspective for a second. And then I would return the question back to them and I would say, when is the last time that someone walked into your institution and asked you for an ACH? When was that? Can you remember? When's the last time you walked into an institution and said, I would like one ACH, please? The 12s of never. It doesn't happen because if you go and ask a random person on the street or even somebody who works in AP or AR at an enterprise, if you ask them what ACH stands for, the majority of the time you're going to get this. And so for those of you who are listening and you might not know, it's automated clearinghouse. It's how bank-to-bank transfers happen in that 1 to 3 day window in the US. And then there's also a same-day option, SD, same-day ACH, so same-day automated clearinghouse, and that has 4 settlement windows. But this whole misconception that nobody's walking into your institution and asking you for an RTP or a FedNow is actually quite a bit of baloney because those people have taken their dollars elsewhere for instant experiences. And we can definitely see that when you look at digital wallet trends in the US. There are so many examples. I mean, you just referenced that you have multiple relationships with multiple financial services entities, whether they be a bank, a neobank, it could be your E-Trade or your trading platform for your stock brokerage. It could be a Chime. There's an entire section of the population that doesn't engage in traditional banking relationships and like a $5 trillion total addressable market in stored value in digital wallets that never sees a DDA, a direct deposit account. So the biggest misconception is nobody's coming in and asking for it. And it's like, well, yeah, not by name, but they're definitely doing it somewhere else. It's just not with you.
Yeah. I remember when someone told me about Venmo and I was like taking pictures, engagement pictures and things like that on the side, and someone was, asking how they could pay me for my time, and they were like, "Oh, do you do Venmo?" And I was like, "I have no idea what that is." And they were like, "It's perfect for people like you because it's instant. It happens just like that, and like then you can store it in your wallet, and it makes it all very easy and very simple and very seamless." And I was like, "Oh, this magical thing." And yeah, I never even once thought about asking my FI for it.
Yeah, and because we know, right? We've always had these traditional relationships with our FIs, and it's, did you balance your checkbook? Did you walk into the institution? Did you talk to Susie over behind the counter? Been doing this for 20 years. I mean, I was raised in a very rural area, so I am aware of this cultural prestige that we have with analog payment methods. And it's just not the way that the world works anymore. When you look at how people are transacting, I mean, we have this expectation that we are able to move money quickly, and we need to be able to because that's part of how you create financial autonomy, particularly for strategically undervalued populations in financial services. And that's a lot of the user base for these other applications. And when I talk to account holders, so these are end users, people that have these applications on their phone or use them pretty frequently, what they don't know is that the money that's in there is there, but if Venmo disappeared tomorrow, that money disappears too.
Interesting.
Because it's not in a DDA and because they're not an FDIC insured institution, because they're not a bank, and it's the same with some of the other players out there. There's reasons that there are fintech players out there applying for banking licenses. There's a big shift that's happening, and we won't dive into that today, but when you're looking at transactions and who's trying to get a banking license and why, there's a lot to unpack there as it relates to maintaining market share for fintechs and for neobanks.
Interesting. I'm thinking about Starbucks, honestly, and the Starbucks wallet.
Right, exactly. And we've had this conversation before because I've had the privilege to interview with you a few times, and in our work with you, you've seen me talk about this on other webinars. So for those in the audience that have not heard this example from me, so when you talk about digital wallets, there's basically two buckets. Bucket one is stored credential. So that's your Apple Wallet, not your Apple Cash, your Apple Wallet. And that's where you put your plane tickets and your concert tickets and your boarding pass and your card when you're going to go do Apple Pay at the supermarket or whatever. That's a stored credential. Your credential, your credit, your card, whatever that happens to be, sits on your phone. But there's no money in it. It's a connection to the end value. The second example is stored value. So stored credential, you store the credential. Stored value is the money is parked somewhere and then is transacted on your behalf. So for example, I drink a lot of coffee. Many people do. I'm sure there are a lot of people that are listening today that have the Starbucks app on their phone that has money sitting in it. Well, if you look at that across the entire population of people that drinks coffee at Starbucks, the stored value, the actual dollars and cents that is in wallets for Starbucks is $2 billion, which is a larger asset size than a significant portion of FIs in the United States. I go on stage regularly and I tell financial institutions that Starbucks is a bank that sells coffee because they have that money. Starbucks has that money. And then they make their financial decisions based on that. They get to trade and transact on that money because it's already in their account. It's already in their wallet.
So wild, but fascinating at the same time.
Exactly. People just don't see it because they don't aggregate it. We don't think to aggregate it in our mind, right? But if you think about people who are listening today, you think about every app that you have on your phone that allows you to, quote, move money instantly or transact instantly that is not directly affiliated with your bank, how many of those apps you have, and then how much money on average is in each of those applications. None of that money is FDIC insured. So if any one of those entities disappears, your money disappears along with it, which is literally the case for FIs to get on the faster payments rails.
Yeah. So going into some more real-time payments conversations, it also means a fraud risk. So how does the fraud prevention playbook need to change when transactions are happening in seconds or instant?
I love getting this question from practitioners because I also think it dovetails into the misconception side of things. When you're settling transactions in seconds, you're significantly reducing the fraud window. So the window that a bad actor would have to get in the middle of the transaction and then to create some kind of bad action or to get in the way of where the money is supposed to go. There are going to be things that change significantly in fraud prevention, but the rails themselves are secure. So the RTP network is secure. The FedNow service is secure. It's more about looking at, one, the reduction of the fraud window. So one of the biggest issues that we're seeing in the industry right now in terms of fraud is checks. So there's a huge issue, especially since the COVID-19 lockdown in 2020, with check theft, check washing, There are people who have access to check data that they can just then revise and resubmit, which is another form of check washing. And that window of time, so let's say you place a check for your gas bill in the mail, and with the mail system going as slowly as it has been, unfortunately, for the last couple of years, you're talking about probably a 5 to 10 day window on average where you don't know who has that money.
Mm.
So your gas company could say, well, we didn't get it. And you can say, yeah, well, here's a picture of me putting it in the mail and the check's not there. Somebody's already gotten a hold of it, which is creepy, by the way. And I think we can all agree that digging through mailboxes to find someone's checks is really creepy and like weird on so many levels. But it is happening, and there are fraud rings that are doing this because they're also now targeting smaller institutions because they realize that these institutions might not necessarily have the level of sophistication to catch check washing fraud quickly, and most institutions don't. Why would you? It's so far outside of like the digital ecosystem. So that's one aspect of it, is that we're reducing the fraud window for bad actors from analog payments when you're talking about an instant payment, something that's irrevocable, that goes from one place to another in 20 seconds or fewer. And on average, it's like 5. The other thing is, and this is kind of my perspective, and for those of you who have not heard me speak before, I am like this all the time, and it's you can't fix stupid. There's a lot to be said in terms of, and this is a big Zelle example too, and I'm not the world's biggest proponent of Zelle for a lot of reasons. However, I do think that as FIs, we have a lot of lessons to learn from why there's so much fraud in Zelle. Like, why is that happening? If you are an institution that has deployed Zelle and you have a fraud problem, that is an education problem. That is an internal problem. And it is something that you can solve for if you learn where those bad actions are happening. Is it friendly? Did I send it to the wrong person on accident? Is it I am sending money to my like mail order boyfriend in the Philippines? Like, there are a lot of, or I'm going to buy a puppy. Please don't tell my dog I said that. He's laying right here. But like, oh, puppy scams. Like, oh, I'm going to pay $1,500 and I'm going to go buy a corgi. And then you drive to Sedalia, Missouri, and nobody meets you at the Walmart. It's like, well, okay. Or you meet the person at the Walmart, you hand them $1,500 in cash, they drive away and hand you a puppy, and you're like, well, this is an Australian Shepherd. You can't really do anything about that once the person drives away with the $1,500 any more than you could do it if you did it through an electronic transaction method. So the idea around the faster payments equals faster fraud argument, I don't think carries as much weight as people gave it credit for at the outset for faster payments adoption, because within both faster payments rails, so we're talking RTP network and FedNow specifically, the fraud rates are so low that they're essentially negligible across both networks entirely. It's less than 1%. And that's even high. Like, I'm saying it's less than 1%. It's less than that. We will see more of it. I do think that that will be something we have to address, but we've already had this problem. So when we're looking at fraudulent transactions and even friendly fraud within our institutions, we have more than enough data to make educated, informed guesses and or decisions with our account holders to try to protect them from bad actions. And the last thing that I'll say on this topic too is that it's always going to evolve. There's never going to be this golden kite solution where fraud just goes away forever. That's just simply not going to happen, because there are going to be bad actors and they're going to exploit systems for their own gain. We're seeing this across the ecosystem. The best things that we can do are to know our account holders and then to adapt as quickly as we can. And the key example of this, and I'm sure many of us have noticed this in the last several years, the two-factor authentication process to log into, because it used to just be log in with your password to your online banking, log in with your password to your mobile banking on your phone. And now it's biometric. There's a Face ID, or when we still had the white buttons on our phones, for those of us that work with the fruit, you need to put your finger on it. Same thing for people who don't work with fruit. Um, and then it's now turned into the situation where, yeah, you log in with your credentials, but then there's also the biometric option and even maybe 3FA where it's sending you a code, either calling you with it with an automated voice or texting it to you. And it says, and it went from, and I remember this a few years ago when this started happening. My institution used to just send me the code. They text it to me. Here's your code. Have a good day. Now that text message says, do not give this to anyone. Have you lost your mind? This is only for you. And if somebody's on the phone asking you for this number, you are not talking to somebody from here. And that's a complete shift from where it was 10 years ago. And a lot of us remember that. So I think as we learn more about bad actions and the way that those are taken, and we learn and do our own KYC, AML, understand our customer base, we're going to be able to get out ahead of it and to educate them properly on how to defend themselves.
Yeah. I think about it all, like going back to your check fraud example, we don't get checks and birthday cards. It is, I Venmo'd you the money.
Yep.
And I'm like, oh, gone are those days. You know, we don't get those birthday checks anymore. But I just, as you were saying that was the scenario I was thinking about.
We all have those examples. We seriously do. And there's an attrition risk, right?
Mm-hmm.
In certain cases, and I'll just say this, my parents are boomers. I'm a millennial. My parents' gas company reached out to them because the gas company, so their utility, said, we are no longer accepting checks. It is no longer considered to be a secure payment method with us. Mm. So you can either drive your payment here yourself or you can do ACH. Because they also didn't want to do the card option. So the card option was like this separate third thing that they could do, right? But what happens is when you do these card transactions online, and many of us have seen this either in our utility, our phone bill, or doctor's offices as well, where there is now a fee that gets tacked on if you pay with a card rather than with your bank account information. And so there is this risk of customers not wanting to comply because of the way we've always done things. However, when you're talking about overall account holder experience, if your utility company, if your doctor's office is saying, well, if you pay with a card and there's a logo on that card, then we're charging you 3% on top of your $1,000 medical bill, that's going to create some headaches. And so this is where we start to see when you pull at that little bit of a thread in terms of account holder experience and what they want, what they're expecting from their engagement in the world around them, we have a unique opportunity to come in as trusted institutions and as fintechs, by the way, to all my fintech friends out there today, as fintechs to say, hey, we have a solution. It's secure. Do you want to work with us instead? And it'll save you 3%. Who doesn't want that?
Right. What are some other emerging applications of instant payments that could change how consumers and businesses are interacting with their banks? You just alluded to it, but I feel like there's way more potential out there than what we've been talking about.
There are so many, but I'm going to focus on two, and they're on opposite ends of the spectrum in terms of business relationships. So outside of just the me-to-me, P2P, A-to-A aspect, which a lot of us are familiar with because of our individual experiences with fintech, in the SMB space in the US, there's a huge opportunity here because well over 2/3 of businesses in the US are considered to be an SMB, a small to medium-sized business that has fewer than 20 employees. And those businesses face a lot of working capital pressure. They may not have fully spun up accounting departments. And if any of us are the local first people, like a lot of people in Kansas City where I live are, we've noticed that pressure because, as in the doctor's office example that I alluded to, fees for interacting with the card rails are going up significantly. And it is also expensive to engage with Block/Square or PayPal because those transaction fees are now getting close to, if not upwards of 4%. Mm-hmm. That is a lot of money to have that bite taken out of what you're earning as a small business, just to be able to have the function to let somebody swipe a card. That's just where we're starting, is 4% plus what you have to pay to be registered as a business with them, the headache that it is to maintain that you are a business and not a money launderer, because that's happening to a bunch of artists that I know, not super fun. And then you have to pay to maintain the hardware, the iPad or your phone or the little widget that attaches to one or both of those items so that you can take that payment at the art studio or at the farmer's market. What if there was, and this is coming, QR code availability? So you go to your local farmer's market or your local coffee shop down the street from you. Maybe they were cash only and now they're trying to find a new way. You go up, you make your order, and they say, okay, would you like to pay? You scan a QR code on your phone, and it immediately pops up with the ability for you to do an instant payments transfer from your bank account to their bank account. And it's all secure. It's almost the same experience as tap. You're just using a QR code. And many of us have done this. I mean, the lockdown, if nothing, probably saved the lives of QR codes everywhere, because everyone told me it was a fad 10 years ago. And I was like, I think there's more to it than this. And then the whole world shut down and you had to read your menu on your phone. So it kind of saved the QR code idea. But there is this idea for request for payment, RFP. And that involves QR codes and scanning a code and then making a secure transaction via RTP network or FedNow from bank to bank. That helps a lot on the SMB side of things. It also has additional applications for enterprises. So when you look at the corporate model and you look at supply chain in B2B specifically, so business to business transactions, I've never seen something more broken. And that's where I cut my teeth in this industry, was B2B payments. A lot of those payments are occurring on a check. They're analog. There are issues with the check is in the mail, but then it doesn't match the invoice number. AP and AR get completely out of whack. When you look at instant payments and the application for instant payments in an enterprise format, in supply chain, in manufacturing, in these larger businesses, you then have the ability to, one, have a QR code, two, because of the ISO 20022 data formatting, you have the ability to attach the invoice and or to include over 100 fields of data and information about what that payment is for. And if you pair that with an AI solution to post to the general ledger in your enterprise resource planning system, your ERP, you're looking at saving people on your teams hours, if not days, per month in reconciliation. So there's a broad range of application for RFP, and I absolutely think that RFP and send are going to be what skyrockets the adoption of instant payments in the US.
Yeah. I mean, I've seen a lot coming out about the QR code payment, and it just seems so intuitive. And, I had to log back into my TV the other day and I had to scan a QR code with my phone, right? Just like you were saying with the menus, I never once viewed that as an inconvenience. It's like, oh, okay, great. Okay, click, done.
Awesome.
Like
can I send you a code, or click this if you're outside of the geofence where you normally are? Can we send you a text just to double check that this is you for this instant payment? It'd be the same thing as what used to happen with card behaviors when you traveled internationally or you traveled out of state.
Yeah.
Those cards would get shut off because you're like, well, why are you in Brazil? And it's like, my aunt lives here. What's your problem? And it's like, well, you didn't call us.
I will never forget the day that I called my bank and I was like, hey, I just want to put a travel notification. And they were like, you don't have to do that anymore. And I was like, what do you mean? I'm going to Europe. And they were like, yeah, you don't have to do that anymore. Like, we know it's you.
And that went away quickly. Do you remember you used to absolutely have to, even if you went from Kansas to California?
Yes.
It would flag you for fraud and you'd get a phone call from somebody at the bank. Why are you in California? Well, my brother lives here. How are you?
Did you just spend $26 at GameStop in California, in Burbank? And you're like, yeah, I'm buying a gift for my nephew. Yeah, but those days, it still is a little wild to me. Every time we go to travel, I'm like, oh, I don't have to check that box anymore.
And when they started with online banking and mobile banking, it moved from you have to call us to you can set it on your online or mobile banking. And then that's gone away too. There's not even like a menu option in my online or mobile banking to set a travel alert.
No.
They've given up on me. They know I'm never home.
Okay. Some institutions are viewing instant payments as defensive. Others see it as growth opportunity. Which perspective do you feel like is more accurate? I believe I know the answer, but
Both. It really is both. I think that it is a massive growth opportunity for a lot of reasons, and this delves into a little bit why it's also a defense opportunity. There are financial institutions out here that need to hear this. We missed the boat. We made a mistake by not looking at fintech more seriously 15 years ago, 20 years ago. And that's why we're having this kind of whole digital wallet economy that is operating outside of our four walls. I can also say with fair amount of confidence, we've seen a lot of consolidation in this industry in that same time frame. So if you look at maybe 08-ish to now, there's been a significant consolidation in the number of FIs in the US specifically. There's only fewer than 10,000 now. And while that seems like, oh my gosh, that's a lot, there's 300 million people here. And there are people that do need access to funds and access to capital. And what I'm seeing is in this consolidation movement, I think we're going to see another wave of it. Because if there are institutions that don't focus on innovation and they don't focus on providing more instant experiences, then those customers, that will create attrition. Those members, that will create attrition. I've seen credit unions buying banks because they're punching above their weight, which is wild to me. My credit union is about to buy another one and expand their footprint in the Midwest all the way down into Texas. Like, I just got a letter in the mail that they're doing this. It's a big merger. It's also a more friendly regulatory environment. Do with that what you will. I won't get into that particular aspect of the topic. But essentially, when I talk to institutions that are in mid-market and below, I say, this is your chance to punch above your weight.
Yeah.
You have market share that you can capture from different generations, different verticals, different populations and types of businesses within your communities that need you. They need your help to understand their payments behavior and how to optimize it. And you should be their trusted advisor. So on a more psychological level, it's about creating and maintaining that trust with your account holders. On a market competitiveness level, it's about not getting absorbed into some multinational that doesn't care that you've known Susan since she was 5 and opened her co-checking account with her mom.
Yeah.
And then from the third aspect of it, it's a growth opportunity. When I talk to financial institutions about why they should be on the rails, I say, receive first. Start there and just be available to receive the money, particularly with stock market gains and sports betting. These two markets have fundamentally transformed how people want to move money in and out of their bank. Because once again, those are stored value. And those, if I win $10,000 because the Chiefs win on Sunday, I want that money in my account. I need to buy my dog his ice cream. Okay? I want that now. Not a week from now, not 3 days from now, not tomorrow. I want it now. Yay me. And so there's this whole receive first strategy, and I think that's amazing. Then you can look to the future. So now you've got more dollars in your bank, your credit union. More dollars are coming in. Great for your liquidity position. Then when you look at send an RFP, as I mentioned earlier, that is monetization opportunity. So banks and credit unions make money on deposits and loan activity. And you can also make money by charging for premium payment services, particularly in B2B, because if you can undercut established payments rails that are expensive, by charging for something that costs you less than a dime, you're completely changing your revenue structure. And this is definitely something we're seeing in the market. So this was something that we didn't really predict last year, but has been really surprising in a good way, is that instant payments in the US are actually cannibalizing wires, domestic wires, because wires are so expensive and they're not particularly transparent to the end users of how the money is getting there, when it's going to get there, why is it $78 when it finally gets there, but I sent my brother $100.
Yeah.
If you transact that over an instant payment rail, you basically take that, $22 and it goes down to maybe $1. And consumers are tolerant of this. And we know this because for those of us that have a Venmo or a PayPal on our phone, and we have the ability to transfer instantly for a fee of 1.25%, how many of us have already done that?
Mm-hmm.
I can't because my credit union can't do that. I'm going to go talk to them someday and be like, are you serious right now? I live in a city that has a lot of very large entities that are in like the top 50. So it's nice, but also they're a little bit behind. And so when you think about market tolerance for charging fees for premium services, it's not even that you would have to do it on your individual account holders. You might be able to, and I can provide strategy sessions on this for anybody who wants to hear me wax poetic about what this revenue structure and growth model could look like. You could create a tiered fee structure based on the size of the transaction and then basically just charge in, let's say, treasury services or corporate treasury or your commercial side of the business and charge that 1.25 to 2.5% to them to do instant payments for send and receive so that everything kind of squares up on that side of your house. And then on the other side of the house with the individual people, you wouldn't have to charge them at all. Or you could charge them less than 0.5% because you're already making that money back and some for premium payment service revenue. And then it also replaces the fees that you would lose in wire.
That's really cool.
It's a very long explanation, but I am like super bullish about this. And I will tell literally anybody that is a fintech in the space or that is an FI that is looking at this, there is money to be made here. There is a $5 trillion pie and everybody wants a piece and everybody should get a piece. It's not that hard. You just have to try.
No, I think it's a cool concept to charge on the commercial side of it. My husband does this is a small aside, but he makes custom suits and he has this like little small business. But when we went to set up all the back end business accounts, what a pain in the butt. And getting everything set up and the little instant thing, and do you do the square or do you not? And it was a whole thing. And those credit card things really ate into the margins, those little credit card fees. And we spent a whole thing. He was like, do people even have checks? I don't even know if people have checks to just like checks or people don't carry cash anymore. And it was a whole thing about it. And we were like, man, that's why we have so many FI relationships. We had to go get a relationship with a much larger institution because none of our local FIs were able to give us the instant payment experience that we really needed as a little small business to make that happen. So,
and that's true for the market. So for those of you that are listening today, you just heard a personal anecdote from somebody that had to deal with this. And the market tells us that on average, an individual person has 4.2 FI relationships. And you just heard from an individual that dealt with this that they went somewhere else because their local FIs did not support the functionality that they needed as small business owners. We don't want that for our account holders. The market's telling us this. The attrition rates are telling us this. The consolidation rates are telling us this. And for those of you who said nobody came in and asked me for an RTP, well, actually they did. And you didn't have it. So what are they doing now? Dealing with somebody in New York.
Yeah.
Yikes.
So if you were advising a community bank CEO on whether to invest in instant payments this year or wait, what factors would you like them to consider?
I think that you should do it. Start with receive first. That's table stakes. Just say, yes, we're going to do it. Start with receive first. Then you need to determine who you're going to implement with. Is it going to be your core? Are you going to try to do it yourselves? Or are you going to engage with a third-party service provider? If you decide to go the route of a third-party service provider, the Fed and TCH both have resources on their websites with their trusted third-party service providers. Your short list is already done for you. You just have to go, they work with institutions around my size, and they've done this, and this is about the implementation timeline. Yeah, let's go. So just start there. Yes, we're going to do it. Receive first. Decide who you're going to do it with or how you're going to do it. And if you choose to do it through the route of a third-party service provider, go to the two entities who already did the due diligence for you. And do it fast, because the cores are falling behind.
That, I feel like, is a different conversation for a different time.
Had to sneak that one in there right at the end.
Well, it was such a pleasure having you on today. Thank you for being a guest on the State of Fintech podcast.
Absolutely. Thank you so much. Thank you to everyone who is listening. And if you want to learn more about Pidgin or me or Payments Elsa or any of our projects, we are easy to find on LinkedIn. You can find me anywhere at Payments Elsa. Or if you want to learn more about my team and how we might be able to help you all, feel free to reach out to us at www.pidgin.net. Cheers, everybody.
If you enjoyed today's episode, make sure to follow the State of Fintech podcast wherever you listen to podcasts. We release new episodes weekly featuring the leaders and innovators shaping the future of financial technology. And if you haven't already, head over to yorkpublicrelations.com to download the full award-winning 2025 State of Fintech Report. It's packed full of insights from industry leaders about where the future of fintech is heading. Thanks for listening. We'll see you next week.